This is Life and Finance in USA, your guide to earning, spending, and living in America. In 2026, millions of people across the United States are still keeping their savings in traditional banks earning 0.01% interest. That means if someone has $10,000 sitting in a regular savings account, they may earn less than a cup of coffee in interest over an entire year. Meanwhile, others are earning 10, 20, even 40 times more without taking stock market risk. The difference is simple. They understand high-yield savings accounts. Today, he walks through what high-yield savings accounts are, how they work, which ones are popular in the USA right now, and how beginners can choose the right one safely. And for anyone serious about building emergency funds in 2026, this might be one of the most important financial decisions they make. Before going further, here is an important disclaimer every beginner must hear. This video is for educational purposes only. Interest rates change frequently, and the accounts mentioned are not financial advice or personal recommendations. Everyone's financial situation is different, and viewers should always verify current rates directly with the bank before opening any account. Now that that is clear, let's continue. What exactly is a high-yield savings account, and why are banks paying more? A high-yield savings account, often called HISA, is simply a savings account that pays a much higher interest rate than traditional brick-and-mortar banks. Traditional banks may offer 0.001% to 0.10% APY. High-yield accounts in 2026 are commonly offering between 3.5% and 5% APY, depending on market conditions. Why the difference? Most high-yield accounts are offered by online banks. These banks do not have thousands of physical branches. Lower overhead costs allow them to pass higher interest earnings to customers. And for beginners, this is important. High-yield savings accounts are not investments. They are still savings accounts. They are typically FDIC insured up to $250,000 per depositor, per bank. That means the money is protected the same way it would be at a traditional bank. Who should actually use a high-yield savings account in 2026? He explains it clearly for beginners. A high-yield savings account is ideal for emergency funds, short-term savings goals, down payment savings, travel funds, wedding funds, money that cannot be risked in the stock market. It is not designed for long-term wealth building like retirement investing. That is where index funds and IRAs come in. But for safe cash storage, it is one of the smartest moves in 2026. Let's talk about some of the most popular high-yield savings accounts in the USA right now. Interest rates constantly change, but these banks are consistently known for competitive rates and beginner-friendly platforms. Here are some well-known names Americans are using. 1. Ally Bank. Ally has been one of the most trusted online banks in the United States for years. They typically offer competitive APYs, no monthly maintenance fees, and no minimum balance requirements. Their website and mobile app are beginner-friendly, which makes it ideal for someone opening their first high-yield account. Ally also offers buckets to organize savings goals inside one account. That feature is powerful for budgeting. 2. Marcus by Goldman Sachs. Marcus is backed by Goldman Sachs, one of the largest financial institutions in the world. It is known for straightforward savings accounts with no fees and competitive rates. Many beginners appreciate the simplicity. No complicated features, just a clean savings product. For someone who wants stability and a recognizable financial name, this can feel reassuring. 3. American Express, National Bank. Many people know American Express for credit cards, but they also offer high-yield savings accounts. These accounts typically come with no monthly fees and solid interest rates. The brand recognition gives beginners confidence, especially those already using American Express cards. 4. Capital One 360 Performance Savings Capital. One offers a competitive online savings product under its 360 brand. It combines digital convenience with access to some physical branches, depending on location. For someone who wants both online features and occasional in-person access, this can be appealing. 5. Discover Bank. Discover is another well-known name offering strong APYs and no fees. Their customer service is often rated highly, which matters more than most beginners realize. Because when something goes wrong with money, customer service suddenly becomes very important. How much difference does a high-yield savings account really make? Let's break it down in simple numbers. If someone saves $15,000 at 0.05% interest, they might earn around $7 per year. At 4.5% interest, they could earn around $675 per year. Same money, same safety, massive difference. Now imagine that over 3 to 5 years of emergency savings sitting untouched. This is why financial literacy matters in 2026. What beginners must check before opening any high-yield savings account. He emphasizes this carefully because not all accounts are equal. 1. Check the APY, make sure the rate is competitive. Rates change frequently. 2. Confirm FDIC insurance. Never skip this step. The bank should clearly state FDIC insurance coverage. 3. Look for fees. Avoid monthly maintenance fees or hidden service charges. 4. Check minimum balance requirements. Some accounts require a minimum deposit. 5. Understand withdrawal limits. Savings accounts may limit certain types of withdrawals per month. 6. Review transfer speed. How quickly can money move between checking and savings? Beginners often focus only on the interest rate. Smart savers look at the full picture. Is high-yield savings better than investing in 2026? This is where many Americans get confused. A high-yield savings account is about safety and liquidity. Investing in index funds, ETFs, or retirement accounts is about long-term growth. They serve different purposes. Emergency fund, high-yield savings. Retirement, investment accounts like 401k or IRA, trying to build generational wealth, stocks and assets. Mixing them up can cost years of progress. What risks should Americans understand? High-yield savings accounts are safe in terms of principal protection under FDIC coverage. But there are 2 realistic limitations. 1. Inflation risk. If inflation is higher than the interest rate, purchasing power still decreases. 2. Variable interest rates. Banks can lower APY anytime based on Federal Reserve policies. This is not a fixed investment. Rates move with the economy. That is why it is a cash management tool, not a wealth strategy. How beginners can open one step by step. Opening a high-yield savings account in 2026 usually takes less than 15 minutes online. Step 1. Choose a bank. Step 2. Fill out personal information. Step 3. Link checking account. Step 4. Transfer initial deposit. Step 5. Set automatic savings transfers. Automation is powerful. Even $200 per month automatically transferred can build a $2,400 emergency fund in 1 year, plus interest. Consistency beats motivation every time. Why 2026 may be the perfect time to move your savings. With economic uncertainty, layoffs in some industries, and rising living costs across the USA, having a strong emergency fund is no longer optional. It is protection. High-yield savings accounts are not flashy, they are not exciting, but they are foundational. And in personal finance, strong foundations win long-term. The biggest mistake beginners still make: they delay. They keep researching. They wait for perfect timing. Meanwhile, their money sits earning almost nothing. Opening a high-yield savings account does not require perfect knowledge. It requires one decision. The bottom line for Americans in 2026. A high-yield savings account will not make someone rich, but it will protect them. It will grow their emergency fund faster. It will help them sleep better at night. And in uncertain times, peace of mind has value. If someone in the United States still has their savings sitting in a traditional low-interest bank account, 2026 might be the year they finally make the switch. Because sometimes, the smartest financial move is not about chasing more risk. It is about earning what they should have been earning all along. This is Life and Finance in USA, where money meets real life.